And so we said, there's got to be a better way to invest in real estate in a completely capital efficient manner where I could just throw in $250 into multiple different properties, solve for concentration risk, and get rental income, appreciation in real time, and the tax benefits. And so that was what we were trying to solve.
Hi, and welcome to Common Denominator, a podcast about growth, mindset, and entrepreneurship. I'm Moshe Popek, and today we chat with Alex Blackwood. Alex is the co-founder and CEO of Mogul, the blockchain-based investment platform creating efficiencies throughout the real estate industry. Alex co-founded Mogul Club after working at Goldman Sachs to give new and veteran real estate investors unparalleled returns. And now, back to my conversation with Alex. Hi, Alex, and welcome to Common Denominator.
Thank you for having me.
The business that you're currently running, Mogul, is super, super cool in my opinion. I studied a lot. I understand it. But tell the audience what Mogul is.
So Mogul is effectively a platform, an online-based platform where someone can sign up and in less than 30 seconds be invested in shares of a cash-flowing single-family rental property vetted by industry professionals. And so they receive rental income on a monthly basis, appreciation in real time, and tax benefits at year end, all starting at $250 minimums, all the way up to $250,000 investments.
So how does that work? In other words, what problem was Mogul solving for? What was the issue, and what's the value creation of what Mogul is doing?
When we initially set out with Mogul, the idea behind it really came because myself and co-founder, we faced this problem. And so we were both at Goldman Sachs and their real estate private equity group working 80 to 100-hour work weeks. And we thought, we really want to invest in the type of quality of asset that we were investing in during our day jobs, but we just didn't have the time. And so when we looked around to the different platforms that were out there today, we didn't see the returns that we were getting. We weren't seeing the high teen returns. We weren't seeing the 18.8% that we're averaging currently. And so we said, there's got to be a better way to invest in real estate in a completely capital efficient manner where I could just throw in $250 into multiple different properties, solve for concentration risk, and get rental income, appreciation in real time, and the tax benefits. And so that was what we were trying to solve, is solving for the capital requirements, the time commitments that you had to do, all of which we thought were a tremendous burden on the investor. So we decided to create this platform where someone could come in and not spend 40, 80 hour a week managing a property, not spend the time to actually diligence and make sure that an actual market or an individual property within a market was sustainable in the long run or a capital efficient investment.
And how many markets are you currently in?
So we're currently across, we look at about 7 markets, I would say. We're primarily located in the Houston and Dallas areas. We just think that they're incredible markets primed for outsized growth in the near term and long term. Outside of them, we have some in a blue chip area right outside New Jersey. We have some in California. We're looking at a few in Florida right now. We're looking at a few in Nashville, Atlanta, Charlotte, a few others as well.
So the model would be to buy single family homes and then have rental income. Is that the general real estate type of product? Would be single family homes?
Yep, single family rental properties, typically long-term leases or short-term leases. We operate them, cash flow them, and syndicate out the equity in them. And so everyone receives that rental income on a monthly basis and appreciation in real time.
And so your platform, because I've seen different iterations where there's the platform and then they'll go to other third-party sponsors or other third-party landlords, and they'd help connect the equity with the owner. Are you guys also finding the assets and managing it, and then the second hat also running the platform as well?
Yeah, so we actually find and syndicate out the equity. We kind of do the whole gambit, so to speak, using a programmatic relationship with inventory partners throughout the US to onboard high quality, top notch assets that create value day one.
That's because I always looked at our main business. We're in multifamily, we're in office and assisted living, different different types of real estate assets. And I did see BlackRock, Goldman, Morgan Stanley buying a lot. Maybe they've bought maybe 40%. I think I saw recently maybe 40% of single family homes. So what is the general model from a business model, just a plain real estate business model? What is the idea of buying single family homes? What's the business proposal?
The pitch really is a cycle agnostic investment that is a necessity of life. I mean, boiled down to it, everyone needs somewhere to live, whether it be that they're renting it or whether it be that they're acquiring it. And I mean, both angles, right? Renting, you're going to get rental income from a tenant that is going to come in and rent your single family home. But at the same time, if they're acquiring it, that means there is a ton of demand in the market. And so other commercial real estate investments, if you think about the potential buying pool or you think about the potential tenant pool, I mean, office is a prime example of this. Obviously, it's going through a pretty massive downtrend in this current cycle, given the interest rates and the slim yields that they had. But if you look at offices, the people that can buy Class A offices, there are only a handful of sponsors that can do that. There are maybe 5 to 10 that could afford $100 to even $500 million office building. And then when you look at the tenant pool, there are maybe a couple thousand companies out there that would be buying for it, not to mention within a local area, even lower than that. And so when you think about that, there's great tenant risk because there's a massive concentration in the amount of people that could actually come in and rent from you. In addition to that, there's a limited pool of buyers. So you have to hope that one of them is in a position of capital to come in and acquire that building from you at the appreciated value. But if you think about homes and you think about single family rentals, you and I rent, everyone, or obviously buy or whatever it might be, but everyone at one point or another most likely did rent a home. And the average age of home buyers is going up to, I think median right now is about 35, and it's continuing its climb, especially given the current cycle that we're in. And so the people that are renting are driving up the rents, which are driving up the yields to the end investors that are acquiring these homes. But on top of that, the demand is still going to always be there because even if there isn't an institution that will come in and purchase it, your buying pool is massive because everyone wants a home to acquire. I mean, it is synonymous
The
with
American
the American
dream,
dream.
right? Exactly.
Yeah, exactly.
Right.
You kind of finished my sentence.
Exactly. I was just like, how many years of marketing after World War II, right? It's like, let's buy a home. I mean, I have my own thoughts as to why, it's not always yes, the marketing slogan is the American dream, but I can make arguments why someone in their entire life should just rent compared to buy. It's not so clear cut. It's not one size fits all when it comes to buying your home. So you have to look at, I always say real estate is very local and your needs are very local, very, very specific as far as what you're going to do. But I find it interesting, in America, they have the idea of accredited investors versus non-accredited investors. So, I mean, you're taking these $100, $250, you're taking these monies of equity. I assume they're non-accredited investors, right? Accredited investors, there's less, due diligence or less regulation with accredited investors. So it seems like you're taking non-accredited investors. So there's probably more regulation. I call it like just mom and pop and just regular folks that want to invest. So how does your platform allow for you to deal with that regulation piece?
Yeah, so I mean, it's definitely something that we spent the entire first year really hashing out. And I mean, going back to the first point too, just high level on the American dream component to it. I mean, that marketing angle has been pushed ad nauseum.
Yeah.
And I joked that, or I don't even, it actually did happen, was when we were first coming up with the branding behind Mogul and the actual marketing push behind Mogul, I would call up random people that I knew that had either bought a property recently for the first time or had made a mint off of real estate after growing their wealth. And I said, listen, and this would be out of the blue. This would be Friday at 5:30. They'd get a call from me, not having heard from me in multiple weeks or even months. And I'd say, describe to me the first time you bought a property. The just first thing that comes to your mind, what is it? And I mean, number one, right off the bat, it was one person described it as the feeling of winning the US Open and dropping to your knees and throwing up your hands in the air that you had finally made it. The second one said that it felt like they were inside the matrix, understanding how it all worked and how they were actually making the system bend to their reality. And then the third and a number of others said, when I went out later that night, my jokes hit harder. I was more social. I was more confident. I just felt better about myself. Like I had this secret that I'd finally gotten into the American dream. And a lot of what we're doing here is to portray that exact brand. It's to come out as saying, yes, you might be signing up. Yes, it might be a 30-second, but at the same time, you're still owning real estate. In fact, you're doing it in a way better way than a number of people have done in the past and generating the same style, if not better returns than you would have gotten yourself. And so that's kind of I completely agree with you. The American dream is a large reality of this, but it's also the idea of the wealth gap and transcending it and actually elevating and leveraging equity in a home to actually move beyond one socioeconomic class into another and even a potential higher one. But that's kind of on the American dream stuff. Just wanted to caveat with what we were discussing earlier. But as to the accredited versus non-accredited debate, we do afford the ability for non-accredited investors to invest. The way that we've set it up is actually each investment is as an investment club. And so very similar to how if you and I were to purchase an asset and go about putting in place a property management company, setting up a PropCo LLC, the individual PropCo LLC that owns the asset is an investment club. And so you and I aren't going to be bothered on the minutia. If someone needs to call a plumber, the property management company needs to call a plumber, $80, maybe $100 taking out rental income. However, if something is maybe above $1,000, we have that threshold of $1,000, it gets put to a vote. So AC bus, we put it out to a vote and a supermajority decides on the outcome. Now, the outcome is typically a binary this or that action statement from the property management company that has come in and provided quotes, but it's still, I mean, the crux of it is providing non-accredited investors the ability to access this asset class without being burdened with a number of different fees or hiding the fees in some sort of disclosure that's hundreds of pages long. And so at the end of the day, this SEC classification was put in place because people were investing together on tennis courts, on golf courses. And so we decided to take the playbook of kind of that old money meets this new money mentality through the investment club structure.
So overall, I guess investment club would be an exception to the SEC deep regulation, right? So it's an easier way to work with non-accredited investors, I guess. And that way, both for them and for you, as far as all those burdens of all the paperwork and back and forth, plus the end result is they can grow their wealth, right? So blockchain is something, right? Tell us the difference between, because a lot of people don't know, right? So they're seeing Bitcoin, they're seeing Ethereum, and then they're seeing concepts like blockchain, right? So these are all in the news, but then just break down maybe 101. What's blockchain? What are these what's stable coins? And how does it actually apply to Mogul, the blockchain?
Yeah, of course. I mean, so everything that we do is actually run through the blockchain. And so high level. I mean, the reason that we don't advertise it everywhere, the first thing that I didn't say when I described the platform was we're a blockchain focused platform that enables investment into real estate. was because there are no too diverse an investor as crypto versus real world asset and real estate related investors. So blockchain high level is simply an immutable ledger. And by that, I mean, it says that if we transact and I send you maybe tokens or you send me maybe tokens, and we both verify that we want that transaction to go through by using our signature, then that transaction will be approved by a third party cryptographically, and it will be stored forever on a literal chain of blocks. And so each block creates that multiple transactions that are stored there. And so each blockchain, we think of it as different highways, so to speak, and getting to that kind of immutable ledger avenue. Now, stable coins, all of that, we actually don't deal with stable coins. We actually set it up where people transact using a simple ACH transfer, credit, debit, wire, whatever it might be. And so the idea behind blockchain and real world assets is actually dated before Bitcoin came about. And by that, I mean, in 1998, a guy by the name of Nick Szabo wrote a white paper that came up with this idea that if you and I were to transact over the internet and I was to sell you my home and I was to send you my deed for funds coming in the door, that a third party could come in, verify and validate the transaction cryptographically, and then our proof of ownership would be carried into infinity and held in an immutable ledger. Now, at the end of it, Nick Szabo said he couldn't get around the third-party bad actor problem, that someone would validate an incorrect transaction. Fast forward to 2008, and Bitcoin comes about. They solved that third-party bad actor problem by creating what's called decentralized consensus mechanism. High level, what that means is a number of people that are completely anonymous, that are minors, are validating that that transaction is correct and both parties want to move forward with it. And so that's solved for the problem that was put in place by a 1998 white paper. We don't see any sort of platform out there today that is actually enacting and putting forward that solution. And so for us, our end goal is to be that solution. We're starting out with fractional investment and creating that value for investors to see the value of blockchain in the back end without having to fully understand what blockchain is.
And I love I think from what I recall recently, all real estate's about $400 trillion. That's where 70% of worldwide wealth is held in. Right, homes or in the U.S., I think just the U.S. 100 trillion. All real estate, maybe 70% of that is homes, right? So it's some number, maybe 50, 60. But every transaction, there's a line item on your closing statement called title insurance. And I always find it fascinating, right? So what you're doing is, right, you're paying someone a premium that if someone else comes and has a claim against your home, you go to the title insurance and you say, you know what? You got to cover me. You got to cut the check or defend my title. And it's a multi-billion-dollar industry. And I think that just using blockchain, right, there's a lot of lobbying against this concept, but just using blockchain where it's perfect, decentralized, right, third parties validating, it's on a ledger, it cannot, right, it solves for trust and honesty, which is a big problem in today's society. That's why blockchain is amazing, and you get rid of like Netflix did with Blockbuster. Right? You get rid of a multi-billion-dollar industry. But nobody's really talking about it because, unfortunately, the title insurance companies lobby millions and millions of dollars every year to the politicians. So
I mean that line item in my first closing statement can largely be attributed to the creation of Mogul. I was entirely frustrated. I didn't understand why someone was being paid to hold my funds in escrow. I didn't understand why it wasn't just a smart contract. I didn't understand why 99.999% of the time I will never need that insurance that I paid thousands at the closing table for. And I completely agree with you. It's an industry that much like Netflix, yes, they did destroy one business in Blockbuster, but they create an industry that is far more valuable than the one rental business that it destroyed.
I think that, I thought about this again as I dabbled in this with my wife, this space of real estate, both debt and equity, many different types of real estate using the blockchain. And the journey is still ongoing. So kudos to you that you're actually doing it, right? Actually doing it, because it's hard. I'm sure you've come across in different conferences and places you've gone of people talking about it, but you're doing it. It's a big difference, right? I always say,
how did you,
right? Go ahead.
Yeah. No, how did you go about educating yourself on blockchain? Because obviously it is very new.
So I'm a real estate guy, and my wife's partner, she went to many conferences, blockchain conferences, crypto conferences, many. So she was that box, and I was going to roll some real estate and give that fractional ownership into a platform that we were going to create, and then and we're still on that journey, but you got to run fast and break things, right? So I'm trying to balance that. Where I consider myself to be a turtle instead of the rabbit when it comes to investing, right? So I'm working on it, but it is real. It is good. It might take some time, but you're going to have many dinosaurs. The real estate industry is considered a dinosaur. Okay, many areas, many businesses, many spaces have been disrupted. And I think that you're one major piece for doing that, right? Imagine someone in Tokyo wants to invest in Miami, right? And they're just able to just go boom, zoom, and everybody has pieces of real estate in wherever it is. So I think that's great. You talked a little bit before about just again for the audience, tax benefits of real estate. What is the general? Because I want to talk a little bit about people. It's very different because that's also something that I notice with a lot of people. They don't think about. Let's say they're in business and they're making money. They don't think about their income tax. A lot of people are like, oh, okay, I just made this $1 million. Meanwhile, 35, 40%, if not more, it depends where they live, maybe 50% plus, is going for taxes. So tell us about the tax benefits of real estate.
Yeah, I mean, the most fascinating call I ever had in my life was a 5:30 or 5 p.m. call on a Friday with a CPA that previously worked for a family office, and it was a 2-hour call, and I lost my mind at it. And so, I mean, the primary tax advantage that we point to is the depreciation tax expense. And so it's this idea that you can deduct or protect your rental income that you get from your rental property by utilizing a few things that you can put up effectively as a deductible or against that rental income you have, whether it be operating expenses, insurance, interest on a loan, but property taxes. But one of the main ones that really puts it over the edge, so to speak, is this idea of depreciation. And so the government wrote the tax code to incentivize home ownership. They came up with this idea that said, even though your asset is appreciating in value and the land is appreciating in value because there's a finite supply of it, and maybe a town is getting a ton of influx of population, you can actually utilize the asset structure and say that it is depreciating in value because physically it actually is deteriorating, right, over time. And so the government put in place this idea of depreciation as a ghost tax expense that even after everything that you receive, you can put 60% of your purchase price divided by 27 and a half years, which again, it's 60% of the purchase price is attributed to the improvements, not the land. And then 27 and a half years is attributed to the life of the asset. You can do that on a yearly basis against the rental income that you have. Now, real estate being a slim margin business and you're getting maybe a 8 to 12% yield, or in our case, it's about 12 to 14%, to the end investor, you can utilize that ghost expense, that depreciation, against that yield. Now, in most cases, it will protect, if not eclipse, that yield to the point where even though you're getting 12, 14% rental income, you actually are losing money for the purposes of income reporting purposes at the end of the year to the government. And so it's a massive benefit. And so if you think about it in terms of a REIT versus a private investment, a REIT, 10% will become 5% post taxes because they don't pass along the tax benefits. With us, if you got 10%, that 10% will stay 10% and will actually potentially show up as a net loss for income reporting purposes at year end.
I think that was a great way to explain it, because when you talk about depreciation, it's so hard for people to understand that. And that's exactly right. So these REITs could be paying out 7-8%. You're in let's just call it a 40% bracket. Maybe you're making 3.5%, 4% net in your pocket after taxes, right? If you invest either directly or through your platform, or you have actual ownership, that phantom, that ghost loss, that depreciation, you get to take the benefit of that. That is a huge, huge win. So you take it, and then every dollar in your pocket, you're not paying any income tax, and you keep rolling. And then a few years later, maybe the value of the property went up. You know what you do? You refinance out, right? So, because now there's more equity in the property, and that refinance money is tax-free as well. So real estate, the reason why it is a tool for wealth building is because the tax code is set up that way. And it just allows, if you hold it, that's the general idea, right? If you hold it for long term, that's what I'm a proponent of. Hold for at least 10 years. And why would you want to sell? Everything has a headache, right? So every type of asset, every type of business, every type of investment, this headache. Why sell it? Pay closing costs going out, buy something else, or do a 1031 exchange, which is an exchange, a like-kind exchange, which means you don't have to pay tax, and then buy a second headache. Keep all headaches, right? Right? And then have economies of scale. Right?
1031. I love the one that blows my mind to this day, because it's in combination with the refi, is when you pass at the end of your life, you can pass it on to your kids, and the step up in the tax basis is at the asset's value in real time. So they sell it. It's like they actually recorded a neutral, not a net gain or loss at the end of the life.
Right. So if you just hold it, now the only thing to solve for, which I've been doing estate planning, but there's a little trick to solve for, is the estate tax, which currently is at 40%. However, you can gift for a husband and wife, let's just say each of us, maybe about close to $14 million, maybe about $13.5 million each, husband and wife. So you maybe have about $27 million or so. And you could put that into a trust. And then if there's even more above that, you could still put everything into a trust and take back a note. And then you could use charitable donations. But that's more complicated for a different show. But that 27 million, I would, because real estate over the past 100 years appreciates by 3%, and you want all that appreciation to be outside of your estate. Anyhow, so but you do lose the step up basis because it's not in your estate anymore. That's true.
Yeah.
So
yeah.
that was really really cool. So one thing we talked a little bit about the show. So you were at Goldman Sachs before, and I always find this fascinating. First of all, how was that experience working for a big investment bank like Goldman Sachs?
It was incredible. Those years, I learned a tremendous amount in a very short period of time. But my experience, actually, a lot of people probably heard about, and that's not because of me, but actually, if you had seen a few years ago, this PowerPoint that came out on investment banking.
Sure. Yeah.
And so that was actually a group that I joined a week before that PDF or presentation leaked. So it was a wild experience. I learned a ton in a very short period of time. And then when I moved into the private equity division within Goldman, you felt nearly invincible because you had this background and foundation that even though it was 2 years, it felt like it was more like 10. And so you had that throughout your time, and it was hard. It was very, very, very hard. But at the end of the day, I like to joke that it was not nearly as hard as when I was a student athlete at Georgetown and was on the rowing team. And so I do have that as kind of the baseline of difficulty, and it definitely helped during my time in investment banking and real estate private equity. And you learn from the smartest people. You learn on a daily basis every different type of transaction style across the corporate infrastructure, across real estate, across debt and equity investing.
And right, so here you are, right? Hard but stable job, and then you make the choice. You know what? I'm gonna let all that go, aka like Jeff Bezos, right? Let's just go sell books. And you had this idea. How long has it been since you've been on this journey with Mogul?
About 2 years and 1 month. Moved out here in late August, and about 2 years ago now.
Yeah,
which has been wild.
And I assume no regrets.
No regrets. I would say it's definitely harder than during my time at GS, but no regrets whatsoever. I think what we're doing and we're seeing the fruits of our labor pay off. And the fact is, our customers have been, the actual enthusiasm for the product, their response to the product, the emails that we've received of just gratefulness and thanking us for creating this platform and starting it has been more than enough. And it's been incredible. And so we've been growing like crazy. The platform assets have been returning 18.8% average IRRs, which is eclipsing every single investment platform out there. And so it's been a wild journey. It's been hectic. I've learned a ton of things filled with high highs and low lows, but it's definitely been a journey that I'm very thankful to have embarked on.
And how would you, what was your process? It's like, okay, I'm going to create this, but then I got to reach out to equity investors. So is it just through different chat groups and things that you're a part of that you're able to make that pitch to invest in your platform?
So it's actually funny. Yeah, we do no paid digital marketing right now. And so we've been growing at a completely organic growth rate, but at the same time, it's been staggering, the growth behind it. And so we started out initially kind of just pitching our around us networks with a private beta to friends and family. We sold out our first asset with just completely friends and family. We circumvented due on sale clause and passed along a 2.625% mortgage in today's interest rate environment. And that asset has been returning, it was like a 98% return last year, which was pretty wild. And so that was how we sold out the first property. Since then, we've just been growing through word of mouth, referral style business, reaching out to people one-on-one, and really picking up the phone whenever anyone wants to talk about it. We are front of line in terms of myself and Joey. We will talk with anyone about anything pertaining to real estate, even if it doesn't have to do with our platform, because the more that we educate an individual, the more that they're likely to educate others and keep that financial literacy education alive and talking more and more about real estate as that generational wealth tool that we obviously have been pushing.
You definitely have a lot of clarity because it's rare actually in the real estate space because you speak to a non-real estate person and you're talking terms and ideas. But it's refreshing. Definitely speak with you, Alex. But what's something today that you're grateful for?
I guess two things. One, my co-founder and team. Without my co-founder, I would not have embarked upon this. I joke that I had actually pitched him in a diner in Dallas, this idea, and I brought with me a sweat-stained notebook that I had traveled New York with and pitched him kind of scribble, because I don't write well, by the way, but pitched him on this idea and he didn't call me crazy because here we are. And so he's been, I would say, the biggest catalyst behind creation of Mogul and driving it forward and everything that's come out of it. And the second one I would say is the support of family and friends behind it. I mean, when you first jump out into this, it's kind of that, and I'm sure you had it to some experience too. You're terrified. You think that when what you're going to put out there, it makes so much sense in your mind, but you don't know if it'll resonate with people. You don't know if you'll be ridiculed. You don't know if someone will start talking about you behind your back. And then at a certain point, you realize that one, you don't truly care about that. And two, that's pretty selfish thinking that someone would actually care enough about you to talk about you that much and to try and bring you down. But at the same point, all my friends and family and my now fiance has been entirely supportive of this journey. And without them, I don't think myself or Joey could have realized any of this over the past 2 years. And my team has been incredible. Our head of engineering, head of marketing, head of sales. And so it's been a pretty wild journey nonetheless.
Yeah, it'll definitely take off. I love those times. Like right now you're hitting your stride, right? 2 years, usually takes between a year and a half, 2 years. So now, and then it's like this, like kind of, flatline and then boom. So you're on your way. That's, but what do you find the common denominator amongst all real estate kind of investors? What do you see is the factor there?
Value, I would say. A number of them, no matter who we're talking to, come to us and come to the real estate investment because they're looking at something to generate long-term wealth in a value-oriented sense. And by that, I mean the people that we don't attract to the platform are the people that will play the stock market, for lack of a better term. And by that, I mean, it's not that they're not investing in the stock market, because they definitely do, but they're not going to be upset if something doesn't jump up 100 percentage points in a day, because at the same time that jumps up that much, it can also fall by that much in the stock market. And so all of our investors and the people that we've been talking to, yes, they love the idea of the rental income, but the appreciation that goes on in the background, the tax benefits that you're generating over time, that is what they're here for. Yeah. They come in with this idea of stable value growth over time. Yeah. And that's why, for instance, I mean, more likely than not, an investor on our platform will invest a second time. And second investment as percentage of first investment is around 233% on average. So people are coming in, testing the waters, and immediately coming back for more and starting to treat it like an interest-bearing savings account than any sort of kind of asset that jumps up and down in value.
Yeah, it really is a completely different mindset than most businesses. And once you get it, once your mind is wired correctly, you just enjoy it, and it's a beautiful game. Well, Alex, thank you. This has been really, really informative and great. How can people learn more about you and about Mogul?
Yeah, I mean, thank you so much for having me, first and foremost. And second, if people want to get involved, if people want to start investing in real estate for $250 minimums, head over to our platform at www.mogul.club. Once again, that's www.mogul.club to learn more. We just launched a few properties. One sold out in a 2-week-long period. The other one is about to sell out, and a third one is on its way in the next little bit. But we have tremendous amount of opportunities on there. Get started in 30 seconds or less. Get rental income in real time, appreciation, and tax benefits at year end.
Beautiful. Thank you so much, Alex. Thank you. Good luck.
Thank you. Appreciate it.
Thanks so much. Hope you enjoyed my conversation with Alex. If you're watching on Facebook or YouTube, we'd be grateful for a like, share, and subscribe. And if you're listening on Apple or Spotify, feel free to leave a rating and review. Have a great day, and I'll talk to you again soon.